trading. Joining us now is Scott Wren, Senior Global Market Strategist at Wells Fargo Investment Institute, and Ali McCartney, Managing Director at UBS Private Wealth Management. A good day to have both of you on. Scott, you think the market is in the process of bottoming at these levels? Why?
We think so, Sarah. And let's face it, we're not sure what Vladimir Putin's going to do, because if you cut off the supply of energy, even part of it going into Europe, that's kind of the wild card here. So if that does not happen, when we look out, we're seeing good, economic growth here in the States. We're seeing employment numbers moving the right way. We think that inflation is going to decelerate as we look out over the next 12 to 24 months. So I think there's some good things going on. We're only about 10.5% off the all-time record high, which is not that big of a pullback. But we think this is an area where if you have a 2+ year time horizon, you probably ought to be sticking your toe in here and trying to buy some stocks if you have excess cash.
Ali, do you agree? Is that what you're telling your clients?
Yeah, really down to each point of the analysis, right? The data and the fundamentals of the economy have not changed. I think what has changed today, especially, which has led to a really meaningful risk-off environment, as you can see in bonds going up, commodities going up, and basically everything going down, is this concept of the changing world order and what the long-term implications are. If you're looking at oil, for example, UBS did some work on modeling in what could be the worst case scenario with regards to Russia, Ukraine, and the provision of oil to the world and to Europe. And even if we had a really sort of tail event, which I think is what the markets are trying to avoid and price in at this point, which would be oil over or at 125 for 1 to 2 quarters, that would take at most about 0.5% off of global GDP. So certainly that is enough to dampen growth, but not enough to stop growth or to continue the rebound, the cyclicality, the reopening. And so especially on days like today, where cyclicality, things like industrials, things like oil, things like financials are sinking, this is definitely a day to get in and to build long-term positions.
Scott, a month ago, the chief concern and the main preoccupation of this market was what the Fed was going to do. The market was kind of falling over itself to raise its estimates of exactly how many times the Fed might hike this year. The market now has taken some of those anticipated hikes off the table, at least for now. Is that a net positive, or does it set us up to perhaps be wrong in the other direction again if, in fact, inflation stays high and the Fed feels like they don't have to necessarily, ease back as much from their plans?
Well, I think, Mike, we just debated this at the Investment Strategy Committee meeting today. I think the consensus for us is that, we've got 4 hikes penciled in. If we're wrong, it might be a little bit more. We don't really think that the Fed's going to take into account what's happening in Ukraine. Inflation is high, and they're going to be pretty dedicated to knocking it down. But really, you're right. We were down 10%. Just because people were uncertain as to what the Fed is going to do, and we're still down 10% off the all-time record high. Now, that's not to say that Russia and Ukraine don't mean anything, because they do. Just look at the grain markets and oil, as Ali mentioned. But, for us, the market's expecting the Fed to do something about inflation, not just sit here. These readings are too high for them to not start on this now. They're not going to do 50 in March, at least in our opinion, but you're going to get 4 hikes and maybe more this year.